Are Canadian real estate prices really hitting a four-year low? And what's driving this trend? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. Let's get right to it. In recent news, Canadian real estate prices have reached a new four-year low, marking a significant shift from the highs seen during the pandemic-era boom. A typical home price fell to $679,900 in October, which is a staggering 20.2% drop, or $171,700 from the peak in March 2022. This decline comes as sales continue to fall and inventory levels hit a record high for the month of October. Despite the easing of borrowing costs, the demand has not kept pace, continuing to exert downward pressure on prices. This trend highlights the ongoing adjustments in the market as it moves away from pandemic-inflated levels. In another development, Canadians are tapping into home equity lines of credit, or HELOCs, at the fastest rate seen since 2012. In September alone, balances grew by 0.7%, which translates to an increase of $1.28 billion, bringing the total to $178.92 billion. This represents a 4.2% increase from last year. The surge in HELOC debt is intriguing, as it coincides with flat retail sales and a wave of investment property completions, raising potential concerns over leverage. The precise reasons behind this increase aren't entirely clear, but it's a trend that warrants close observation, especially for those of us involved in multifamily real estate investment. Meanwhile, Canadian housing starts experienced a significant drop in October, falling by 46,000 units to a seasonally adjusted annual rate of 232,800. This represents a 17% decline. However, economists at BMO suggest there's no immediate cause for alarm, as there are nearly 360,000 units currently under construction, which is double the volume compared to a decade ago. This wave of completions is expected to add to the already record-high resale inventory, further tempering expectations of any immediate supply issues. It's important to consider these dynamics as they play a crucial role in shaping the multifamily housing landscape. Additionally, Canadian household debt is on the rise, increasing by 0.5%, or $14.8 billion, to reach a total of $3.14 trillion in September. Notably, mortgage debt accounted for just 55% of this increase, which is unusually low. The majority of the growth came from consumer credit, such as credit cards and lines of credit, indicating that households might be relying more on short-term credit to manage their expenses. This shift in borrowing behavior could increase vulnerability to economic shocks, a factor that multifamily investors should keep an eye on as they assess risk and opportunities in the market. Lastly, Canadian retail sales experienced a slight dip, falling by 0.7% to $69.8 billion in September. This decline was primarily driven by a 2.9% drop in motor vehicle and parts sales. However, when excluding gas and motor vehicle and parts dealers, core retail sales remained flat, suggesting a general stability in the retail sector. Despite these challenges, the population growth continues to drive demand, presenting opportunities for multifamily real estate investors to capitalize on the need for housing solutions. Art Benavidez recently reported that Texas is solidifying its position as a national construction powerhouse, with 4 major cities making it onto a new ranking of the 15 U.S. cities building the most multifamily housing, according to the Daily Overview. This list underscores where developers are most actively responding to the growing demand for apartments, driven by population increases and affordability pressures that are reshaping real estate markets across the country. Austin leads the charge in Texas, securing the #1 spot among all U.S. cities in terms of multifamily production. The Daily Overview attributes this boom to the region's rapid population growth and a thriving tech economy, which together have created an unprecedented demand for housing. Developers in Austin are transforming the skyline with dense, modern communities that appeal to young professionals and families alike. Dallas follows closely behind, ranking at #2. This reflects its status as one of the nation's fastest-growing urban centers. A steady influx of new residents, coupled with a robust job market and a business-friendly environment, has spurred a wave of high-rise and mixed-use developments throughout the metro area. Houston makes the list at number 9, where city leaders and developers are actively promoting multifamily construction as a key strategy to expand affordable and attainable housing options. As the economy in Houston continues to diversify, new apartment projects are emerging across both urban and suburban landscapes. Rounding out the Texas representation is San Antonio, which claims the number 10 spot. Here, rising home prices and strong population growth are fueling the demand for multifamily housing. The city's expanding portfolio, which includes both luxury and affordable apartment communities, reflects efforts to cater to a growing and increasingly diverse population. Collectively, these 4 Texas cities highlight the state's ongoing dominance in large-scale housing production and its remarkable capacity to accommodate sustained in-migration levels that few other regions can match. This trend is a testament to Texas's ability to attract and retain residents through a combination of economic opportunities and housing availability, a dynamic that multifamily real estate investors should certainly take note of. Max. Canada has made a significant move by hiring seasoned commercial real estate professional Damon Conrad to lead its commercial business operations. Damon Conrad, who has joined Max from Royal LePage Commercial, brings over 2 decades of experience in real estate, predominantly in Toronto, Canada's largest city. At Royal LePage, he served as a vice president and general manager, and his career includes impressive tenures with Cushman & Wakefield, SNC Lavalin, and Second Cup Canada. In his new role as Vice President of Commercial for Max Canada, Conrad is expected to drive the growth of the company's commercial sector across the country. This includes spearheading the adoption of new technologies to enhance operational efficiencies and service delivery. Max. Canada, which is headquartered in Denver, notes that the timing of Conrad's appointment aligns with a pivotal shift in the Canadian real estate market towards fundamentals such as steady rental income, creditworthy tenants, and prime locations. This strategic hiring comes amidst a backdrop of rising borrowing costs and economic uncertainties that are influencing real estate market dynamics. Don Kotick, president of Max Canada, expressed confidence in Conrad's ability to elevate the firm's commercial offerings, citing his proven track record in building national platforms and expanding agent networks. Kotick, who assumed leadership of Max Canada in April, emphasized the importance of Conrad's role in navigating these market changes. Damon Conrad himself has highlighted Max Canada's momentum and vision as key factors that attracted him to the company, along with its innovative use of artificial intelligence in real estate operations. Conrad's notable achievements include winning the NAIOP Real Estate Excellence Award for Office Lease of the Year in the Greater Toronto Area and being recognized as one of the top 100 most influential voices in Canadian real estate by Buzz Media. Founded in 1973, Max is one of the world's largest real estate companies, with over 145,000 agents and nearly 9,000 offices across more than 110 countries. This latest leadership edition underscores Max's commitment to strengthening its commercial real estate presence in Canada, a move that could provide exciting opportunities for multifamily real estate investors looking to capitalize on these evolving market conditions. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. See you on the next one.